Now let us discuss some risk-free income generation options. We will talk about staking of network currencies, DAI Savings Rate, and stablecoin liquidity pools on automated market makers. Let us start with staking of network currencies. Now, many blockchain networks on which Web3 platforms can be built either use proof of stake consensus or some kind of hybrid consensus mechanism that too supports staking. Ethereum itself is very near to its migration to proof of stake. Now, Ether and other network currencies are often reserve assets for Web3 treasuries as they provide liquidity for the reserves and are used to pay network fees, that is gas fees. These network currencies can be staked in the proof of stake validation process to generate a risk-free return. Take the example of Ether staking. Staking Ether is analogous to lending Ether to the Ethereum protocol, therefore making it an agreement between the bond issuer, that is the Ethereum protocol, and the bondholder, that is the staker. After ETH2 merge, the yield earned on staked Ether might be considered the risk-free rate of the Web3 economy. Now let us talk about DAI Savings Rate. Many Web3 treasuries hold DAI stablecoins. This is obvious as DAI is one of the most popular stablecoins. Now, DAI Savings Rate is the interest rate that is provided to depositors of DAI to the Maker protocol. Now, we already discussed that DAI is issued as collateralized debt obligations. The DAI borrowers or the DAI issuers need to pay an interest on the DAI issued to them. This interest is called the stability fee. Now, DAI savings rate is kind of opposite of the stability fee, as it is the interest DAI depositors to Maker protocol earn. Maker governance uses the stability fee and the DAI savings rate as monetary policy tools to control DAI supply and demand and maintain the peg of 1 USD. When DAI is trading below its peg of 1 USD, to increase demand for DAI and therefore increase DAI's price, Maker governance might choose to lower the stability fees and raise the DAI savings rate. Conversely, if DAI is consistently trading above its peg, demand for DAI can be lowered by raising the stability fees and or lowering the DAI savings rate. The DAI savings rate is therefore one of the most risk-free ways DAO Treasuries can earn a yield on stablecoins. This is because all DAI deposited into the smart contracts will accrue interest paid out to the protocol itself without being subjected to much credit risk. Now let us talk about stablecoin liquidity pools on automated market makers as a source of risk-free income for treasuries. The yield generated from trading fees earned by liquidity providers on certain stablecoin pools on automated market makers can be another risk-free way treasuries might be able to earn yield and diversify their non-operating income. For instance, USD DAI pools on Uniswap and other automated market makers do not expose DAOs to any kind of credit risk or impermanent losses, while allowing them to earn a portion of the trading fees generated by the protocol.